Well, it is 9:14. The Federal Reserve is expected to raise its key interest rate again today. And here to break down what this might mean for the economy, we're happy to have on the show Bankrate.com's chief financial analyst, Greg McBride. Greg, thank you so much for taking the time to join us today. How are you?
I'm great. Great to be with you. Thanks for having me.
Yeah, glad to have you here. Now, as we've been telling people, these incremental rate hikes are designed to try to slow down the economy and cool off inflation in the process. Assuming this 3/4 point rate hike we're about to see starts working in cooling things off, how long do you think it would take before we start seeing some of those effects?
Well, we're still waiting to see the effects on inflation. I mean, another 3/4 percentage point hike today brings the cumulative total over the last 6 months to 3 full percentage points. It's already having an impact in terms of slowing the economy, and we're going to see more of that in the months ahead. But we're still waiting for that to show up in inflation. And as long as inflation remains stubbornly high, that's going to force the Federal Reserve to continue to do more interest rate hikes. So today will not be the last.
Yeah, and we're wondering how high they go. Of course, we're coming off a baseline where they were almost at zero for years. But back in the late 70s, early 80s, when we saw inflation ramp this high, they had to get that federal funds rate to over 10%, nowhere near where it is now to start getting inflation to cool off. Do you see that happening? And if so, what's different with our economy this time around?
Significant differences in the sense that back then interest rates were a lot higher. They were starting from a much higher point, not from the near zero levels as we were this time around. The other thing is that situation that we found ourselves in the early 80s, where the Federal Reserve had to raise interest rates to double-digit levels, and we had back-to-back recessions. That's because the preceding decade, they really dilly-dallied, and they didn't take inflation seriously. They didn't see the job through, and so they never really put the inflation issue to bed. It kept rearing itself again and again, and that sort of forced that really aggressive action in the early 80s that had some pretty dire economic fallout. The idea that the Fed has now is, let's just get this job done once and for all now. Even if it does mean some pain in the short term.
Yeah, and that's the thing. What is that pain going to look like? Back in the 70s, it was essentially the Fed chair Volcker was creating a recession to try to cool things off. This time around, the Fed chair thinks he can cool things down without dropping us into a recession, or at least further into a recession, depending on how you want to define it. That seems like that's a very fine balancing act. Is it even possible, in your opinion?
Yeah, I wouldn't bet on it. It is a fine balancing act. Look, even the best hitters in baseball fail 70% of the time. So the Fed has a very difficult job on their hands, and they were late getting started, which only makes it that much more difficult. So, no, I don't think we're in a recession now. But yes, I think we will be in 2023.
Okay, Mr. McBride, thank you so much. I know it's not always good news talking about this thing, but it hopefully will be best for the country in the long run, even if, like you said, there is some short-term pain. Thank you so much for taking the time to join us. We do appreciate it.
Thank you, Tim.
Thank you.